Hey everybody, welcome to Trading Capital Exclusive Analysis. Today is currently July 24th, and we've kicked off another market session. Today was really just a consolidation inside day. Fairly quiet for the major indices, although you did have the majority of the strength in the S&P 500, the SPY ETF here up 0.45%. And then you look at the QQQ. The Qs were actually going to be the indices that sold off, or they still finished positive, but they dipped into that negative territory as some potential lightning before the mega cap earnings was taking place, as well as the J. Powell Fed FOMC meeting on Wednesday. So tomorrow you have the mega caps starting to report. I believe it is Google and Microsoft up on deck tomorrow. Let me just see here, Tuesday, July. Yeah, so after the bell you have Microsoft 2.5 trillion deep, and you have Google 1.5 trillion, and then you have Visa as well, which is another big one. In the morning you have the home builder Dan Texas Instruments, NextEra Energy. Some important stocks for specifically ETFs. You know, when you look at the X series ETFs, the XLKs, XLUs, XLIs, etc. Now, jumping back to the Qs here, you can clearly see we're still fairly elevated. The volume has subsided off of that initial dump candle, this wide range red bar, which is slowly starting to shape up to be a positive thing, which is why I think we saw the markets finish slightly up on the positive side today. Needless to say, the Qs really haven't filled the major technical gaps to the bottom, nor has it hit this major technical support. It came very close, but now considering that you bounced prior to that level, it's going to mean that likely if we come down on tomorrow's session, or if we come down on J. Powell's session, this support level won't be as strong. There might be some sort of a bounce, but it certainly won't be as strong as, say, you know, filling this gap fill around 368. Now, needless to say, if we start consolidating above this range, that's actually technically positive, and it's working off this overbought scenario. So that's what we got to watch for. Are we going to get some consolidation holding this key 20-day moving average? You can clearly see since we broke out of that massive uptrend, you know, this nice bull flag consolidation pattern here, it's really been holding above the 20 moving average ever since you started consolidating here. So that's going to be the big support level to watch. Whether or not we get a daily close below that level and confirmation is yet to be seen. If we remain here, then it likely favors a continuation move to this high pivot gap, and then we'll have to reassess from that point on. Now, if we look at the small caps held up well today, but interesting enough, that early morning pump when the volume is most significant, let me just take you to the 10-minute chart. You actually see the IWM over here having a solid attempt at a breakout, touching this key 196 area over here and putting in this beautiful 10-minute topping tail and reversing. That later just managed to be the high of the day, and that was a pretty nasty sell on volume. So there was an attempt when you had the most liquid volume in the morning, and that attempt failed. And you clearly see we've been getting rejected at that key level here now multiple times. Once, pretty much twice, 3, 4 times here. So that's clearly the level in the downsloping trend line to beat for now. But it's a very tight range on the indices for the last few trading sessions. But needless to say, the Russell did finish up positive today. Now what was interesting is that the markets finished up. They didn't really react to the dollar. I think people are still believing the dollar has completely broken down here, and the dollar's had a nice climb back up above this key 100.847 level. I still think at the minimum you're going to get a retest of this key trend line, but there's a strong chance that you can negate that key trend line if the dollar continues momentum, and really specifically if the Fed maintains their hawkishness. And why I think they're going to have to be exceptionally hawkish this go around, specifically on Wednesday's meeting, is Let's just keep asking ourselves one question here. So we look at the 2-year yield, and the 2-year yield sitting at 4.91, another plus 1.42% rally today, reclaiming the key 20 moving average. Notice how we said this is the big level. Now that the 2-year yield has reclaimed the 20 period moving average, you look at the QQQ, it makes you wonder if we're actually going to lose that 20 moving average. That's typically how it should be correlated, specifically since the divergence as of late is so great when you look at tech and the yield market. But the question that I want to ask ourselves is, why is the 2-year yield almost back at the cycle highs of these interest rate cycles? So when you look at when we hit this level over here and this level, inflation at this level was sitting at around 9.1%, you know, pretty much the peak. and inflation was probably sitting at around 6 or 7 here. Inflation is now at 3% headline CPI, but the yields are pretty much at the levels that they were when inflation was at 7, when inflation was at 9. So clearly that's a signal from the bond market saying that, hey, we don't really believe that the inflation rate, at least the CPI reported number, is the real entrenched number. Or maybe it's not a case of believing or not, maybe it's just a case of the markets always being that forward-looking mechanism device, and they realize now that inflation might be on the near-term resurgence. So why do I say that? Well, look what happened in the energy market, say oil. Oil breaking out of a technical 13-month downtrend, and that's pretty powerful that you have to respect at this point in time. So oil's acting very, very well at this point in time. This technical daily breakout actually could put oil making a move. Let me just readjust this trend line, and you can see that the next clear resistance is sitting at right around this $80, $81 Pierce level. But once you consolidate in that range, there's a strong chance oil can move back up to that 84.50 mark. So that's really putting into perspective a move up in the oil market that hasn't really taken into account in the latest CPI print of potentially 20% rally. So imagine the year-over-year comps when you have the price action of oil now being compared to a lower point in time here, and you have oil starting to increase. It really narrows that CPI data, and it starts to maybe skew it towards the upside, which is definitely what the trend is looking likely to do at this point in time. Another positive today was the first daily close of the 200 moving average, really since you've started breaking down at this point in early July. So it's almost one whole year later, the summer cycle over here, and now we're at that summer cycle again, and we're back above the daily 200 moving average, except the only difference is that the daily 200 moving average is much, much lower on the chart at this point in time, which suggests there could be significant upside considering the trend is nowhere near overbought. So what was the strongest sector today? XLE, breaking out of this technical downtrend as well. That's a clear breakout, very, very positive. I never really like to buy this breakout. I like to wait for the retrace back to support, but needless to say, very, very strong breakout in the energy markets. A couple of sectors that were weak were XLU, utilities, and XLV, healthcare, and then obviously energy was the strong one alongside real estate, XLRE, and a couple of the other sectors were kind of just mixed, slightly positive. Financials also did well today. Now, what's also interesting is you have these regional banks, the likes of PacWest. Let's just look at the KRE. KRE is surging today. They carry up 2.5%, closing at a new daily high in the overall breakout trend, and you have interest rates much, much higher. So very, very interesting point here. Maybe the banks really don't care about the higher interest rates because they have the discount window at this point, insulating them from any further downside. But typically when the banks experience these higher rates where we saw them failing, there's generally some that won't be able to sustain, specifically if there is a little bit of a bank run or a cash issue that the banks may have. Let's move along to what the gold market did today. So gold market saw another consolidation inside day. You're still inside of this wide range breakout bar, but gold has been really selling off ever since we hit that 7 days out of the Fed meeting. And the Fed meeting on Wednesday, again, typically is negative for gold. One thing that I'm paying attention to is this trend line, which we're trading under. That's resistance. And then we look at this trend line. That's going to be your big support. If you break this trend line, which is roughly sitting at around 1926, it's a rising trend line, so the price action will go higher as more time passes by. But if we lose that area, then gold likely is going to retest this lower 1800 level where we originally had the major support breakout. All right, let's move along to natural gas. Nothing wrong with natural gas. This is still exceptionally beautiful. It almost had an attempt at a breakout today. Looking at the 8-hour chart or even the 4-hour chart, there's this beautiful inverse cup and handle, head and shoulders pattern, and you look at this inverse forming. We're very, very close to having a near-term breakout. The upside of this intraday inverse pattern takes you well above $3, looking at $3.05 on the charts, and that's with no overshoot to the upside. but I remain very, very positive on nat gas. It's interesting that natural gas has this beautiful bull flag pattern. You're consolidating above the key short-term 20 moving average. Bears tried to take it down today and it got bought right back up intraday. You actually ended with. So what's interesting with natural gas is you do have a couple earnings plays tomorrow. You have AR, which reports earnings after the bell, I believe, and it's going to be a big level because AR is on a beautiful breakout zone over here. You can see it's really fighting this resistance and holding near the highs. So I'm optimistic that AR is going to break out simultaneously with nat gas, and we should see a move probably to this daily 200 MA. You can see that it's been slowly flattening it out as nat gas or AR has been putting in stage 1 basing. So I am optimistic that that comes in better than expected, with the optimism in mind that nat gas is on the near-term precipice of breaking out. All right, let's move along to the mega caps because you do have Microsoft reporting earnings tomorrow, and Microsoft has had a steady pullback into the daily 20 moving average. It's still technically overbought. There's going to be a lot more support at the 50 daily moving average. It just so happens to simultaneously fill a major gap fill before it broke out and made new all-time highs. So that would be a bigger support area that could potentially be bought on the long side for a quick snapback bounce. I do think that you would want to wait for a deeper pullback if you're looking for more of an investment entry at this point in time, but earnings should move the stock one way or another. I do think that Microsoft is a clear short if it gets a pop on earnings. There's a 368.49 target, or even this previous pivot high that would work well based off of these weekly reversal signals at the all-time high. That's very powerful. That just didn't happen on light volume. That happened on an obscene amount of volume in that specific candle. So, and it happened in an attempt at a breakout of a new all-time high in Microsoft. So pay attention to these mega caps because they're still lofty, especially on the weekly charts. I mean, you look at how far it is and stretched from the weekly 20 MA. It really hasn't tagged that area since you had this breakout candle over here. And it can have a fair amount of time being stretched from the weekly MA, 20 MA, but at some point it does typically pull in and touch that weekly 20 MA, which generally does provide a good entry opportunity, specifically since these markets have been trending up over the recent years with COVID stimulus and low interest rates. Now, if we look at Google's another important, specifically around the cloud stock entry, and Google's interesting because it's been very, very choppy. And what I'm noticing here about Google is it's really just been a lot of sell side pressure all within inside this wick. Even though the markets have been positive and strong, Google's just been relentlessly trying to work off this overbought scenario, and now it's actually hitting and fighting this daily 50 moving average support. And the fact that Google has tagged its key daily moving average, the 50, that typically is really good support for the mega cap companies, and it's struggling at this area. I'm observing this price action and it's struggling compared to its counterparties, which means that there's some pretty big sellers that are lurking in Google. And again, I think that if they don't beat their earnings by a substantial margin just based off of this choppy distribution pattern, it would put more pressure on people to sell. Now, if Google pops on earnings, I'm looking to potentially short it if it pops and makes a new high. There's a few resistance points that I have in mind. Really testing this double top scenario would probably be a good R&R setup, and simply I would hold it with a very, very tight stop loss on that trade. But these mega cap companies can make or break the market. So far with Meta and Tesla and Netflix, sorry, not Meta, Netflix and Tesla, we've seen some pretty horrific sell-offs. Tesla did catch a pretty decent bounce today, actually putting in a daily bullish engulfing candle, but still losing that key 20-day moving average. But an impressive move off of the lows from Tesla, and we'll just see if they can hold on to this. I still have an upside target of 335 on Tesla, so there is a chance that based off of this daily reversal candle being its bullish engulfing, if we get some sort of a consolidation pattern before and then another attempt at a breakout, there's probably a long side entry on Tesla. But very, very skeptical since Tesla is very sensitive to rates, and basically rates are surging higher as we speak. On that note, I'm going to sum up this video over here, bring it to a close. Definitely pay attention to tomorrow after the bell. If the markets rally in any more than they have, I think the Fed and Powell has to be very, very aggressive and hawkish. And again, the tone for the market is going to be the mega cap earnings. One could arguably say that the mega cap earnings are or just the reaction of these earnings are probably more important than Powell himself on Wednesday, because we all know the market, the bond market, has baked in pretty much a guaranteed 0.25% hike unless we wake up to banks failing tomorrow and yields dropping substantially. So I think the markets are expecting a hawkish Powell, which is why rates in the 2-year have actually broken out and continuing to test pretty much near the cycle highs, considering inflation is well off of the 9% peak. So that's the question that you just have to keep asking yourself. Rates typically should be much, much lower if the Fed is in their so-called restrictive policy stance, being that the yields are much, much higher than the inflation. But that inversion rate only stays if inflation continues to downtrend. If inflation continues to uptick, then the Fed's restrictive policy range really starts to narrow and tighten, which is what kind of the 2-year yield is sniffing out at this point on. Overall, take care, everybody. Please give this video a big like down below. Subscribe to our YouTube channel. Visit our website where we have more details on our services and trading alerts. On that note, thank you all.